Hey everyone, welcome back to another video. Today in this video, I'm going to be explaining the new week opening gap. This is a very simple concept and it can be easily dismissed. But if you understand this concept, it's going to improve your trading and give you the tools you need in order to take high probability setups. All right. So the new week opening gap, the NWOG, is a price imbalance that occurs between the closing price of the previous trading week, which is usually Friday, and the opening price of the new week, which is Sunday or Monday. Now, this gap is created due to the lack of trading liquidity over the weekend. So here's an example. This candle here represents Friday's close, and then this candle here represents Sunday's open. Now, the gap that's formed between the closing price and open price is what we call the new week opening gap. This is an example of liquidity void. A liquidity void is when there is absence of trading volume. So we can't see any candlestick here. Now, once you've outlined your new week opening gap, you want to take the range high and range low and identify the equilibrium. The equilibrium is called the consequent encroachment. These three levels are very sensitive. As we go ahead, I'm going to explain how you can use it for profitable trade setups. All right. So that we get this precisely, for the Forex market, whereas the Euro USD, USDN, the closing price, all right, the time at which we want to identify the closing price is Friday, 5 p.m. Eastern Standard Time. And then the open is Sunday, 5 p.m. Eastern Standard Time. And then for indices, which we have the DXY, the Dow Jones, NASDAQ, and S&P, the closing price is 5 p.m. Friday, and the open price is 6 p.m. on Sunday. All right, rather than going to the chart to identify the range high and range low of the new week opening gap and then the consequent encroachment, there's an indicator which I'm going to share at the end of this video so you can just put it on your trading view and make things easy for you. Now, how do you use the new week opening gap? I've been able to simplify it into two ways. There are two simple ways to use it. Number one, as a reference range, and then secondly, as an inefficiency. Okay. As a reference range, the new week opening gap serves as support or resistance to price. Price usually reacts from these levels, and that's why you need to note them on your chart while taking trades. Secondly, they define the early week bias and also help you determine what context that week is going to trade. Going forward, I'll explain what that means. Then as inefficiency, they act as target for price. Market tends to rebalance or fill the gap. Now, as inefficiency, you want to use them as you use the fair value gaps and volume imbalance. But you have to take note. Just because price traded through it doesn't mean that price will not return to it. Usually for the fair value gap, let's say price creates a fair value gap. If price returns back to it, we expect it to find support and a rally. We don't want to use this fair value gap again because when price uses a fair value gap multiple times, it reduces the strength. But for the new week opening gap, price can, let's say here's the fair value gap, price can trade through it and even trade down through it and still return to find resistance before going lower. So even if price rebalances the new week opening gap, it can still be used in the future. So we need to take note of that. All right. As a reference range, the first thing we stated is that it serves as support and resistance. Now, I want you to take note of this chart. You can see it has been delineated into days of the week. We have Thursday, Friday, Monday, Tuesday, Wednesday, Thursday, Friday. So we have about 2 weeks. So we have Thursday here, Thursday here, Thursday here, about 2 weeks. And we have about 5 new week opening up here. 1, 2, 3, 4. Sorry, 4. And you can see the consequent equipment as the midline. So, like I said before, I'm going to share the indicator I use so you can apply it to your chart. Now, one thing you need to note is that you can see how price found support here, resistance, support, 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 resistance, breakthrough, support. Here again, you can see support. You can see how price kept reacting to this level. Okay. So the new week opening gap serves as support and resistance. Now, if you look closely, you would see something happening here. Now, the new opening gap also helps to measure strength. You could see how price failed to close above the consequent encroachment here. When you see something like this, it's telling you that this new opening gap is most likely to hold price from going higher. Okay, you can see the bodies that went just above the lower range and then failed to close above the consequent encroachment. You can see how price fell. So let's study another. You can see price failed to close below the consequent encroachment, telling you that this is most likely to hold price from going lower. Okay, now you can see price was able to close above consequent encroachment. You can see how it turned towards support. And as price found support here, it failed to close below consequent encroachment. So this is how you use a new week opening gap to read strength in price movement. All right, you can see here again, price barely closed above the consequent encroachment and then give it a second shot before rallying higher. Here again, you can see just a week through, it did not close below the consequent encroachment. You can see how price rallied higher. Here again, you can see price closed below consequent encroachment and then found its way through the new week opening gap. Here, you can see it failed to close below and then it found strength. Here again, you can see it closed above the consequent encroachment and then it gave way through the new week opening gap. So you want to use these three lines, okay, for a bullish market. If we expect price to be bullish, the probability reduces if the candle closes below the consequent encroachment, and further also reduces if it closes below the lower range. All right, you can see here, as price broke through this new week opening gap, it only wicked through this new week opening gap. It did not even close above the lower range, telling you that price is most likely to continue going lower. So you use the new week opening gap to read strength in price. Secondly, it helps define the early weekly bias and context. So I'm going to start with the early weekly bias. What does this mean? Now, once price creates the new week opening gap, usually if it reacts away from it, it tends to continue in that direction. Now, it doesn't mean that if price goes above it all the time, it will be bullish. And if it goes below it, it will be bearish. No, it's all about probability. Most of the time, when price rallies away from it, it usually continues in that direction until the weekly objective is met. Okay, that's a higher time frame objective. Probably price refilling a daily fair value gap or a 4-hour fair value gap, or running liquidity in the higher time frame, or finding resistance or support in an order block or breaker block in the higher time frame. All right, you can see how price rallied higher from here. Now, the second thing is context. What do I mean by context? You can use the new week opening gap to gauge or to tell if that week is going to be a trending week or a consolidated week. If price leaves the new week opening gap with such momentum, is a telltale sign that that week will be a trending week. Let's look at another example. So here's a second example. You can see how price left the new week opening gap and then kept trending. This was a trending week. In as much as Wednesday was a retracement, this is a good week to take trades. Price did not consolidate. Price moved. There was momentum here. But looking at this example, you can see here's a new week opening up. This is Monday, Tuesday, Wednesday, Thursday, Friday. This is a full week. You can see how price left this new opening up, then returned, left again, returned. Now, when you keep seeing price returning back to the new week opening gap, is a telltale sign that most likely that week is going to be a consolidated week. For that week, you want to trade less and expect less. You have to be nimble. Don't expect like 50 pips run, 100 pips run, or a market to trend for a long time. If you find a trade, you want to just take the little you can get and run away, or don't even trade at all. So you use the new week opening gap to gauge the context for the week. So as an inefficiency, remember I said they act as targets for price. They usually act like magnets. All right, you can see how price kept gravitating towards this area of new week opening up. You can see price, it just kept going back and forth, back and forth. It seemed to attract price. All right, so imagine you are in a trade. If you look at this, we have a fair value gap here, 1 hour fair value gap. And then you see we have an order block. can see our price found support with this order block at this level of what? New week opening gap. And then if you take your fib from this range low to this range high, this will be our equilibrium. I'm just eyeballing it. This will be our equilibrium. So you can see price at a discount. Now, when you see this, with this new week opening up above, you can set your take profit here. Now, this will just help you gauge where price is most likely to go. It doesn't mean that price must get there because we have this swing high here. So it is of a higher probability that price is most likely to go higher. After seeing this, you can see price broke above this new week opening gap and then closed above it, then retraced to find support at consequent encroachment, and then rallied again to break structure, left what? An area of inefficiency, nested at this level of what? New week opening gap. You can see how price came down to find support to rebalance this area of inefficiency, finding support at this new opening gap, and then this order block here. Now, as soon as price begins to rally, the probability that price will rally increases. Why? We have the swing high here. Secondly, we have what? This new week opening gap, because it serves as magnet to price. So you can use the new opening gap as target for your take profits. The next thing I want to explain about the new week opening gap, you don't want to be trading when price is in between multiple new week opening gap, because most likely price is going to range. So you can see we have a new week opening gap here. We have another new week opening gap here. And then we have a third new week opening gap forming a range. And you can see how price kept gravitating towards this new week opening gap, found support, resistance, support, resistance. So we keep going back and forth. These periods you don't want to be trading. So when you open your chart and you turn on the indicator for the new week opening gap and you see multiple new week opening gap above and below price, you want to expect that that week or that month might be a ranging month until price aggressively breaks above or below that new week opening gap. So let's look at the chart example and how we can use this to take a trade. So like I promised, I said I'm going to give you the indicator I use. So this is the name, the new week opening gap. If I leave my cursor on this, you can see it's written in event plus event horizon. So new week opening gap, new day opening gap. So I both have the new week opening gap and the new day opening gap. All right, so I think RTHT. If you come here, the indicators. So here's the name, the new week opening gap, events. I don't think this is it. I don't think this is it. But if you actually do need it, and like if you find it difficult to locate on your trading view, just leave a comment below this video and I'll give the full name of the indicator. All right, so here's the Euro USD. This is the 1 hour time frame. Sorry, this is 15-minute time frame. Let's go to the 1 hour time frame. All right, so here's the 1 hour time frame. And you can see our price kept finding support, resistance, gravitating towards the new week opening gap. Now, price has created a range. We have this range low and this range high. So what we want to do, we want to draw a fib and know where we are. So draw a fib. I think I should take out this so that we can see it clearly. You can see that we are what at a discount. We are below equilibrium. So this is discount. So we buy at discount and sell at premium. So let's bring back our new week opening gap. Now you can see our price took out liquidity here, finding support at this new week opening gap, rallying to filling out this area of inefficiency. Okay, so price moved from what? Discount to a premium. Now we're going to go lower to see what kind of setup we can find here. So going to the 15-minute time frame, you can see our price found support at this new opening gap, taking what? Sell side liquidity. Okay, as soon as it did that, it did what? It broke structure. So it broke this high. Not just that, it also created what we call the ICT order block, leaving what? A fair value gap. So we have a market shift here, and then we have what? A change in state of delivery. Okay, so how can we use this? The area of inefficiency here, price return to it. So we want to outline this area of inefficiency. Okay, now we have 3 confluences. Don't forget. Number 1, price is at a discount. Secondly, price found support where at the new week opening gap. And then 3, price took what? Sell side liquidity. Then the 4th confluence is we have what? A market shift. So we have 4 confluence on our side telling us that price is most likely to rally. So we'll go down to a smaller time frame to look for a setup here. So let's see the 3-minute time frame. I think we should just use the 5-minute time frame instead. Okay, good. Now, as soon as price found support here, we could see it broke this high, but it did not leave any fair value gap. And then there wasn't any change in state of delivery here. If I draw this out. So what is change in state of delivery? Change in state of delivery is when price changes from bearish to bullish or from bullish to bearish. And how can you note that with candles? Now you can see price created these consecutively down close candles. All right, so this is what we call the ICT bullish order block. Now, once price closes above the open, we have what? A change in state of delivery from bearish to bullish. And the reverse is the same for a bearish market. When price creates what? An up close candle, like we can see here, this up close candle. Once price closes, so let me just draw it out so it's easy for us to. This candle here closed below the open price of this consecutively up close candle. This here is what we call a change in state of delivery. What we want to do is we want to wait for price to return back to this open price and then find a trade to sell. The same thing here. We want to wait for price to, you can see that price did not close above this open price. So we don't have a change in state of delivery here. But if you move forward, you would see that this consecutively down close candles, this candle here closed above the open price. So what we want to do is we want to wait for price to return back to this open price before we buy. Secondly, we can see that we have what? A market shift here again, leaving what? A fair value gap. So you can as well use this fair value gap for entry. So if we draw this fair value gap, let's change it to it. All right. I can see our price found support before rallying. Another thing I also want to show us is price is at one of the ICT Q zone. This is the London Q zone. Okay, you want to be taking trades either the London, the New York, or the Asian Q zone. So this is the Euro USD. The best time to take trades are the London and the New York Q zone. You can see our price rallied higher. So you can use the new week opening gap as target, remember. Now you don't just want to work with anywhere. The most sensitive areas in the new opening gap, remember the lower range, the midpoint, and the high range. So when you take a trade, you want to take partials as price gravitates towards any of these three levels. So we have the lower range, the mid range, and then the higher range. All right, I hope this was helpful. Please give this video a thumbs up. And if you haven't subscribed yet, please do so if you want to get more videos from this channel. See you guys next week.